And second most asked question is about foreign income. We have one on the screen here. If with the Freistellungsauftrag, the 1,000 euros tax-free capital gains. If you have this, and many people have brokers from outside of Germany, and sometimes even some creative people have the idea to not declare foreign income. What do you think about those two types? If one has foreign income, and maybe if someone thinks he doesn't have to declare it because it's not made in Germany.
Bad idea. Because if you do not declare your income, which has to be declared in Germany, that is tax fraud, right? So, and there are penalties on it, and huge penalties, and depending on the amount, that can even lead to coming into jail, right? But not if you do not declare a couple of €100, but you have to declare it, right? So there are, let's put it this way, right? If you are a resident of Germany, you have to declare your worldwide income in Germany. Worldwide income means irrespective of source. So if you have brokerage accounts in the US, in China, in India, France, UK, Germany, right? The income received out of that has to be declared in Germany. Only in cases where you might have a dual residency. Let's say you keep your residency in the UK and you have a second one in Germany. We have to look into the double tax treaty where your treaty resident is, right? And the treaty resident is usually determined. So where is your center of vital interest? So center of vital interest is basically where are your main economic and social contacts, right?
Is this 183-day rule?
Has nothing to do with that.
Okay.
Nothing. 183-day rule is a clause also in the double tax treaty, but that's referring to employment income.
Okay.
Right. So that's a complete different rule, and that's not to be discussed here. But you are a resident in Germany or treated as a resident in Germany if you have an apartment here where you live in, which you basically can use on your own. You have rented it or bought it. Or you have a physical abode in Germany, which means you are here for an uninterrupted period of at least 6 months. Right? So then you are treated as a resident. So, and then, and as I said, if you have two residencies in two countries, then there are criteria, the double tax treaty, as I said, by the center of vital interest, where your treaty residency is. And usually, all income, or the right to tax the income according to a treaty is usually allocated to the country of residence according to the treaty. So if we take my example, so if you have two residencies in the UK and in Germany, and according to the treaty criteria, your center of vital interest is in the UK because you're in Germany just for 1 year on assignment. Your wife is living in the UK. Your kids are going to school in the UK, right? Treaty residences in the UK, that means that also your other income will be taxed in the UK. Employment income is different, right? That's basically where you perform the services. But interest and dividend would be in the UK, not to be declared in Germany.
Mm-hmm.
Right? So, but let's take the most cases that your center of vital interest is in Germany or your only residency is in Germany. You have to declare your worldwide income in Germany. Right?
Even if it's negative, does it help you?
It does not really help you. Let's put it this way. So if you have losses from capital gains, yes, you have to declare them. They can only be assessed against other capital gains, not against employment income, right?
Mm-hmm.
But let's assume this year, or let's say in 22, you had losses from capital gains, right? So then you declare them. Then it's stated as a loss carry forward for the next year. And if in 23 you have capital gains, then you can offset these gains against the losses from the last year.
Mm-hmm.
So that works, but not against other income.
Okay.
Right? So therefore, it might make sense. Right? Then another important point is, which I come across a lot, is if you are invested in foreign mutual funds.
Mm-hmm.
That is, from a German tax point of view, a problem. Because mutual funds are only accepted if they are allowed to conduct their business within the EU.
Okay.
Right? So if you are invested in US mutual funds, they are not qualified according to the German tax rules. That means there's a very disadvantageous tax regime with basically a penalty taxation. So the tax is the usual tax rate, but the basis what to tax is calculated in a very complicated and disadvantageous way. So that's therefore my recommendation basically is get out of mutual funds in the US or somewhere else, out of the European Union, in order to be on the safe side. And by the way, that works the other way around as well. So there are financial products in Germany which are not accepted in the US and have a complicated and high tax treatment in the US, right? And as a US citizen, as a US citizen, you have the right and obligation to file your US tax return
Mm-hmm.
irrespective of where you are, right? So and also green card holders. Right? So therefore, this is very complicated, and of course, then recommendable to talk to a tax advisor how to deal with such situations.
Yeah. Just to make sure everyone understands, that doesn't mean that you can't invest in the US. You can invest in the US, but with European ETFs or mutual funds. So they should have an ISIN or a UKN, is what the German one would be, and not these ticker symbols.
That is right, and of course you can have a US depot where you have shares. So if you have, let's say, Apple, IBM, Ford Motor Company shares sitting in a US depot, that is fine. Dividend distribution has to be taxed in Germany. However, that's another important point, is that also according to the treaties, the country of source has the right to withhold a little bit of taxes. It's usually between 5 and 10%. Right? But these taxes will be credited against the German taxes because they are levied in line with the tax treaty.
Okay.
But what might happen is that you have an excess withholding in the source country, right? Because the systems are too complicated or you forgot to mention them, and then you might have that excess holding, and that has to be claimed back then in the source country with the procedures applicable in these countries.
Understood. It's an excellent bridge for the next video where we talk about more in detail about taxes and investments. But before we wrap up, one more question, because I know the community and I know that they exploit what they can exploit, basically, if they're very street smart, let's say. And I know that a question a lot of them will have is that if, for example, I have a real estate in India and I make rental income in India and it stays in India, then their argument will probably be that they make no foreign income because the income stays completely in India. What does or you as a tax advisor, and what does Finanzamt say about this? Do they follow the same logic, or would they say no, this is still income that you're making?
First, it is income what you are making.
I thought so.
But again, you have to look into the treaties, right? And into local rules. So basically, there is one big distinction. It's between real estate earned within the EU. So real estate located within the EU and real estate outside of the EU. All tax treaties basically state that the income from real estate is taxable in the country where the real estate is located, which is in India. So therefore, it's correct, it has to be taxed in India. But in Germany, since it's foreign income, but according to the treaty text in Germany, the exemption from German taxation will be granted, but that income has to be considered for progression purposes. That is what we have talked about earlier.
Yeah.
The income will determine the German tax rate, but only if it's positive. If it's negative, it has no influence. Right?
Okay.
But positively, it influences the tax rate. That rule does not apply within the EU. Within the EU, we can neglect it. Except there is a clause within the tax treaty, like we have with Spain, where it said no exemption with progression, but Germany has also the right to tax it, but will credit the Spanish taxes. Right?
Okay.
So it's always, you have to look where it is, you have to look at the treaty and then to the local rules.
Okay. So I definitely learned something, and I think a lot of people watching too, that worldwide income can have two different effects. One is, do you have to pay taxes in Germany or not? And one is, does it account to your income, which is the progression that you mentioned?
Yeah.
Okay. If people have further tax questions, Dirk, how can you help?
I mean, of course, you have to contact me, right? And then basically what I do is I conduct a Zoom meeting for a quarter of an hour to get to know the person, the requirements, and the topic and the expectations. And then tax advice has a lot to do with trust, right? So both parties, so you and I, have to say, okay, we can work together, right? It does fit, right? And I have the trust in that person, right? And then based then on the information I get from the interview, then I can basically talk about the process, how it works, and of course also about the fees. What does it cost?